If you read the latest real estate headlines coming out of Mammoth Lakes right now, you might honestly think the median price for a single family home just jumped by like over $700,000 in a single year.
Right, which sounds completely insane.
It does. I mean, your initial reaction is probably that the market has caught fire again, like we're returning to the absolute combat of last few years where you had to waive every single inspection just to get a foot in the door.
Yeah, the Wild West days.
Exactly. But today we are going to show you why that massive number is actually a complete statistical illusion and why the real power in this market has quietly but very firmly shifted.
It is a classic case of raw data just totally masking the actual story. I mean, the chaotic battleground of the early 2020s has genuinely disappeared.
Thank goodness.
Right. What we are seeing now in Mammoth Lakes is a real estate landscape
Hmm.
that has it's morphed into a highly deliberate, very quiet game of chess. The adrenaline has left the room, and the calculators are finally out.
Well, welcome to this deep dive, everyone. Today, our mission is to decode a really fascinating document for you, the Mammoth Lakes Real Estate Market Update for July 2026.
It's a great report.
It really is. So if you are trying to navigate a mountain town market that has finally caught its breath, and you want to understand how buyer and seller behaviors are fundamentally shifting right under the surface, this deep dive is absolutely for you.
Yeah, and just to set the table, the data we are analyzing today covers the first half of 2026. So essentially, it's taking our temperature through the end of June.
Right.
And our objective here isn't just to recite a giant spreadsheet of sales figures at you.
Huh.
We are going to explore the mechanics behind these numbers to reveal a maturing market that is currently defined by balance, extreme selectivity, and resilience.
Okay, let's unpack this idea of selectivity because before we dive into the specific property types, the stark differences between condos and single-family homes, we really need to establish the baseline psychological and financial shift defining 2026.
Yeah, the macro view.
Exactly. So the report notes that prices are largely flattening out rather than sliding. They're typically selling, I think it said 3 to 5% below the list price,
That's right, 3 to 5%.
which I think the instinct for a lot of people when they hear flattening or cooling off is to just brace for a crash, right? Like the bottom is falling out.
That is a very common misconception, yeah. But what's fascinating here is that a flattening market in this context is not a red flag. It is actually a deeply necessary, healthy normalization.
Okay, how so?
Well, for years, we witnessed this rapid, completely unsustainable appreciation, right? And that was combined with severely limited inventory. So plateau indicates that prices are now being supported by solid underlying fundamentals rather than just pure speculation.
So people aren't just buying to flip.
Exactly. We're talking about lifestyle-driven demand now, owners holding properties long-term, and sellers who, frankly, have significant equity and aren't highly leveraged. Nobody is panic selling.
Which stabilizes the entire floor of the market.
Percent.
And that stabilization is really closely tied to what's happening with interest rates, which the document highlights as a crucial factor.
Huge factor.
Yeah, so as of mid-July 2026, rates are hovering in the mid-6% range. Specifically, we're looking at 6.63% for a 30-year fixed conforming mortgage and 6.83% for a jumbo mortgage.
Right.
But I want to pause on that spread for a second because why should you, as someone looking at a mountain property, care about a fractional difference between a conforming and a jumbo loan?
That's a great point to bring up. That spread tells us a lot about the liquidity at the top end of the market. Jumbo loans are typically required for those luxury, multi-million-dollar mountain properties because they exceed the standard lending limits backed by the government.
Oh, I see.
Yeah. So the fact that the jumbo rate is sitting higher at 6.83% reflects tighter lending standards. Banks are perceiving slightly more risk for those high-end assets right now.
That makes sense.
But really, the broader takeaway for you as a buyer is that the wild fluctuations we saw early in the rate hike cycle have just stopped.
Right, when they were jumping a quarter point every week.
Exactly. When rates were wildly bouncing around, affordability was this moving target. Now that they've anchored in the mid-sixes, buyers have predictability. They can comfortably map out their monthly budgets, and that restores a massive amount of consumer confidence.
So that predictability basically completely changes the buyer's timeline.
Oh, entirely.
Like if we think about market absorption rates, how fast inventory gets bought up, the last few years were basically a Black Friday doorbuster sale.
That is the perfect analogy.
Right. The doors opened, a listing hit the market, and 50 buyers sprinted toward it, grabbing whatever they could because they feared the inventory wouldn't be restocked.
Yeah, it was total panic buying.
But this mid-2026 market operates completely differently.
It operates much more like a high-end boutique.
Yes, exactly, a boutique. The doors are open, but the shelves are actually staying stocked. The inventory is replenishing at the same pace that buyers are making purchases.
Because of that, you don't have to sprint anymore.
Right. You can walk in, check the price tags, inspect the stitching, and actually take a week to decide if you want the property.
And that shift places a tremendous burden back on the sellers.
Yeah.
The market now aggressively punishes what we call aspirational pricing.
Aspirational pricing, like listing a property super high just to see if someone bites.
Exactly. Sellers are only succeeding right now if they adapt to the boutique environment. If you want a buyer to pay boutique prices, your property needs to be presented flawlessly.
No more listing a place with a broken deck and terrible iPhone photos.
Nope, those days are done. And it needs to be priced according to recent comparables, not a fantasy number. If a home is overpriced or poorly presented right now, it will simply sit untouched.
Which brings us to a fascinating divergence in the data. Because when buyers are taking their time to browse, their behavior splinters wildly depending on what they're browsing for.
It really does.
The report reveals this stark tale of two completely different markets operating in the exact same town condos versus single-family homes.
The contrast is genuinely striking. It illustrates how different segments of a localized geographic area can operate under entirely separate physical and economic rules.
Let's start with condos, which the report identifies as the absolute engine of the Mammoth Lakes market.
Yeah, the volume driver.
The velocity here is solid, driving about 20 sales a month. The median sale price through June is $799,000. Interestingly, that is down just a hair from $829,000 in 2025.
A very slight adjustment, yeah.
The median price per square foot is sitting at 663 triggers, and these condos are taking about 64 days to close. That feels like a highly functional, liquid segment.
It is incredibly functional. When you have 20 transactions a month and around $18.3 million in volume changing hands every 30 days, you have a true, reliable market.
And 64 days is a pretty normal timeline, right?
Yeah, a 64-day closing timeline is the hallmark of a balanced negotiation process. It gives the buyer time to perform due diligence, get their loan funded, and crucially review the homeowner association documents, while still providing the seller with a reasonable exit timeline.
But then we flip over to the single-family homes, and the entire rhythm of the data just breaks down.
Completely falls apart.
It's a much lower volume, highly variable space. We are seeing only about 4 sales a month compared to 20 for condos. And they are languishing on the market, taking 110 days to close.
Almost 4 months.
Yet, despite moving at a snail's pace, the median sale price for these houses is listed at an astonishing $2,037,000. Last year, it was $1.3 million. Okay, let's unpack this. The single-family home median price skyrocketed by over $700,000 in 1 year. Doesn't that mean the house market is absolutely exploding in value?
I get why you'd think that, but no. This is where we run into the absolute danger of reading real estate headlines without understanding statistics. The underlying value of a standard single-family home in Mammoth Lakes did not appreciate by 50% in 12 months. What you are looking at is a massive statistical mirage caused by a tiny sample size.
Walk us through the mechanics of that mirage. How does a number that large get printed in a professional report if the homes aren't actually worth that much more?
It comes down to the specific mix of properties that just happen to sell. When you only have 4 transactions a month, the median becomes incredibly sensitive to outliers.
Because one big sale can pull the whole average up.
Exactly. Or the median in this case. The report notes that during this first half of 2026, there were 6 specific sales that crossed the $3 million threshold.
Wow, 6 of them.
Right. Those luxury whales closing at a very small pool of overall transactions just yanked the median price upward. It is purely an illusion of appreciation.
That is a massive trap. I can immediately see how an uneducated seller could get burned by that.
Oh, it happens all the time.
Like you own a standard older home in town that might be worth $1.2 million. You see a headline that says, Mammoth Lakes median home price crosses $2 million.
Right, and your eyes light up.
You assume your house is suddenly worth $1.8 million, you list it there, and suddenly you're the person sitting on the market for 150 days wondering why nobody is submitting an offer.
That scenario is playing out constantly right now. Sellers are pricing their properties based on a town-wide average. rather than looking at the specific, hyper-local comparables for their exact neighborhood and property condition.
Which just creates stale inventory.
It creates stale inventory and frustrates everyone involved. It is a perfect lesson in why context and volume are everything when analyzing real estate data.
So knowing that volume and price vary so wildly between a standard $799,000 condo and a luxury house, it naturally forces us to ask, who actually holds the leverage in these negotiations?
That's the big question.
Right. If you walk into that real estate boutique today, do you, the buyer, dictate the terms, or does the seller still hold the cards?
To accurately determine leverage, we have to look past the sales prices entirely and focus on the inventory metrics. The most reliable tool for this is the months of supply metric.
Which is what, exactly?
It measures the absorption rate, meaning, based on the current pace of closed sales, how many months would it take to completely empty the available inventory if no new properties were listed?
Got it. And the general rule of thumb there is that 0 to 4 months of supply means inventory is tight, giving sellers the advantage.
Correct.
5 to 6 months is considered neutral territory where neither side has a distinct upper hand. And anything stretching to 7 months or beyond shifts the power heavily to the buyer because they have an abundance of choices and can afford to be highly aggressive in their negotiations.
Spot on. Now, if we apply that metric broadly to Mammoth Lakes, the condo market overall sits at exactly 5 months of supply.
So a perfectly balanced scale.
Exactly. Single-family homes, despite their longer days on market, technically sit at a 4-month supply. So that leans just slightly toward the seller simply because there are so few houses available to begin with.
Here's where it gets really interesting, though. The report shows that looking at the overall supply is just as dangerous as looking at the overall median price.
Yes, it is.
Because when you segment the inventory by specific price tiers, the leverage completely fractures. For those luxury single-family homes over $3 million, there is currently an 8-month supply.
Which is heavy buyer leverage.
Right. If you are shopping for a mid-range condo between $1 and $1.5 million, you are looking at a 7-month supply. Again, the buyer holds the power.
But then look at the upper-tier condos properties priced at $2 million and above. The report flags a dramatic and surprising shift here.
What happened?
Earlier in the year, that specific segment was sitting on a massive 12-month supply.
12 months?
Yeah, a full year. Buyers could demand almost any concession they wanted. But by June, that inventory rapidly absorbed, tightening all the way down to a 6-month supply.
It's like checking the weather app for a mountain town.
Yeah.
You know, the app might tell you the average temperature in the valley is a comfortable 60 degrees, so you pack a light jacket.
Sure.
But when you take the gondola to the peak, you step out into a blizzard. You have to know exactly what elevation, or in this case, what price tier you are standing in, to know what conditions you are actually facing. You can't just broadly declare Mammoth is a buyer's market.
If we connect this to the bigger picture, the micromarkets move entirely independently of one another. And because Mammoth Lakes is a relatively small seasonal resort market, it is highly elastic.
Things change fast.
Unbelievably fast. The conditions can flip in a matter of weeks. A handful of cash buyers might decide to scoop up luxury condos during the spring shoulder season, and suddenly a buyer who thought they had ultimate negotiating power in July finds themselves competing for a property.
Wow.
Relying on generalized data from 3 months ago is a recipe for losing out on a home.
So let's say you successfully navigate that micromarket. You know your price tier, you understand the leverage, and you negotiate a fantastic purchase price.
Okay, best case scenario.
All right, you get the property under asking,
Yeah.
and you have your 6.63% mortgage perfectly budgeted. But the report brings up a trend that is fundamentally altering the underlying math of the deal. Even with a perfect negotiation, the hidden costs of actually operating and owning the property are surging.
This is arguably the most critical section of the report for anyone looking at the condo market. We are talking about the severe rise in homeowner association dues and the increasing frequency of special assessments.
It's getting intense out there.
It really is. These financial burdens are no longer occasional surprises. They are the standard operating reality in Mammoth Lakes.
So you finally get the keys, you've budgeted for your 6.63% mortgage, and then out of nowhere you get hit with a special assessment for a roof. How is this changing the way buyers actually look at property listings?
This raises an important question about the reality of buying today. It forces the buyer to transition from a window shopper into a forensic auditor.
A forensic auditor. I like that.
It's true, though. You can no longer look at the list price and the granite countertops and call it a day. Buyers are now required to relentlessly scrutinize the HOA financials, the reserve studies, and the meeting minutes to uncover pending projects before they even consider writing an offer.
And the report specifically isolates the catalyst for these skyrocketing operating costs. It all traces back to a massive structural challenge across the country, but one that hits mountain towns particularly hard, which is insurance.
Yes.
Insurance.
The availability and affordability of insurance for mountain properties is creating a domino effect of financial strain, isn't it?
We are witnessing a systemic tightening in the reinsurance markets, heavily driven by environmental risks like wildfires and extreme winter weather.
Right, the megastorms we've had.
Exactly. When the master insurance policy for a large multi-unit condo complex comes up for renewal, we are seeing premiums double or triple almost overnight.
Double or triple, that's insane.
It's staggering. Most HOA reserve accounts were strategically funded based on historical data. They simply were not built to absorb a premium spike of that magnitude out of nowhere.
So the HOA is backed into a corner. They are legally mandated to maintain insurance on the structure.
Yes,
Right?
they have no choice. So to pay the new premium, they have to drain their operating funds or immediately hike the monthly dues just to keep the lights on.
Precisely. And the cascade effect doesn't stop there. Because the HOA is diverting all its cash to cover insurance, they no longer have the capital to fund required long-term exterior maintenance.
So the regular upkeep just gets deferred.
Or it gets funded through massive sudden bills to the owners. The report explicitly highlights that special assessments are heavily bridging the gap for massive capital expenditure projects in older complexes, specifically replacing siding, installing new roofs, and repairing major structural wear and tear that comes from decades of enduring harsh alpine winters.
Which means if you are the buyer, early preparation isn't just a good strategy, it is literally the only way to protect yourself.
Without a doubt.
The document stresses that proactive coordination regarding insurance is essential for a smooth transaction. You cannot wait until 2 weeks before closing to ask your broker for an insurance quote, or to finally read the HOA disclosures to see if they're actively debating a massive siding project.
If you delay that due diligence, you are playing financial roulette. You are risking your earnest money deposit, and you're risking stepping into a property that could immediately saddle you with debt you didn't underwrite. The physical health of the building and the financial health of the HOA bank account are now inextricably linked to the actual value of the condo.
So what does this all mean for you, the listener, as we look toward the back half of 2026? It means navigating a real estate landscape that is balanced but incredibly unforgiving.
Very unforgiving.
The gap between a beautifully presented, well-researched property that sells quickly and a poorly priced property that languishes for months is only getting wider.
Success in this environment relies entirely on planning, pricing, and presentation. The era of trying to perfectly time the market to make a quick, speculative profit is over.
The doorbuster days are done.
They are done. The market rewards strategy now. Buyers have the luxury of time, but they must use that time to act as auditors. Sellers can still achieve great results, but only if they respect the intelligence of the buyers and the realities of their specific micro-market.
You really have to know if you're standing in the 60-degree valley or the blizzard at the peak. But, all this talk about soaring insurance premiums and massive HOA assessments for aging roofs, it brings up a much deeper, almost philosophical question about the future of mountain real estate. I know this sparked a specific thought for you when we were reviewing the sources.
It did. If insurance premiums and the required special assessments to replace major structural elements like siding and roofing continue to climb at this trajectory, especially in the older condo complexes that dominate so much of the mountain inventory, it raises a fascinating possibility.
What's that?
Could we soon see a market where the actual construction age of a building dictates its overall value and buyer demand, even more than its location or its mountain views?
Wow. A stunning mountain view might not be worth a mountain of surprise bet. Think on that one, and we'll catch you next time.